Friends, welcome to our today's session. You are aware of that we have already completed our unit 1. Right now, what we are going to do, unit 2, again briefly, we have started some of the concepts of second unit of financial management. Let us quickly recapitulate some of the elements of second unit which we have already studied. After that, we'll be learning some new concept. Let me share my screen with you. So earlier also I had shown you our syllabus content. Right now, if you see the syllabus content of our second unit, it appears like this. This unit deals with various types of financing decisions. And within that, we'll be learning about various sources of long-term capital. These are the sources. That means through these means, we get long-term capital. So these sources includes this thing, equity, debt, term loans, preference shares, hybrid securities, internal bonds. Internal bonds, which is reserves and surpluses. They are part of internal bond. Then certain issues relating to this financing decision, we are also going to learn. Excuse me. Once this is covered, we have already discussed up to this point. Then we are supposed to learn this cost of capital concepts, like computation of cost of equity, cost of debt, cost of reference capital, cost of internal reserve, and finally, weighted average cost of capital. All these things we'll be learning. So, in the first session, right now, I'm going to recapitulate all these sources of long-term capital. So, these are the major sources through which long-term capital the business gets. You know, business needs money to run it. When you start the business, let us say proprietor or the promoters or the shareholders, they bring some money that is called as the share capital. And most of the share capital are in the form of equity shares. Okay, the money that is used in the business means it may be used to acquire assets, may be used to run to meet the day-to-day expenses of business. This type of money which is required, that is called as the capital. This capital can be brought from long-term sources and sometimes from short-term sources also. But since it is a long-term requirement, you need capital over a long period of time. So most of these capital requirements are normally met through long-term sources. And these are what is appearing on the screen before you. These are the various sources of long-term capital. Okay, it is not for 1 year, 2 year, 3 year like this. So normally in the business scenario, short-term we understand within 1 year, which is repayable. And if it is something more than 1 year, but within three years, we call it as, or 3 to 5 years, sometimes we extend. That is, you can say the medium-term capital. Beyond that, we call it the long-term capital. These are subjective terms. So you see, first source of long-term capital is equity. Equity means equity shares. Okay, here the owners of the company are called as the equity shareholders. Okay, equity shareholders in the sense each one of them, or that means per share, the dividend distribution will be equal. Each share has got an equal voting right. Okay, but if someone is having 10 shares, another one, some person is having 20 shares, then depending upon that, voting right will vary. Okay, but per share, rights are same. Therefore, they're called as equity shares. Suppose you are starting a company with a capital of 1 lakh rupees. Right? You're starting a company with a capital of 1 lakh rupees. Let us say there are 10 persons. Each of them may decide to subscribe equal amount of capital, let us say 10,000 each. Okay, the entire 1 lakh can be divided into equity shares. Okay, suppose I'm having equity shares of 10 each. Each share is 10 rupees. So 1 lakh can be divided into 10,000 equity shares. Let us say there are 10 promoters. So each one can subscribe 1,000. Some of them may subscribe more, some of them may subscribe less. This is what we understand by equity shares. I think this is clear. Okay, now, next type of source for long-term capital is debt. Debt means borrowing. Okay. And here, in the context of capital, one type of borrowing is called as the bonds or debentures. Okay, so there are some people who invest money in this bond and debentures, and for the company, that is a borrowed fund. Borrowed fund in the sense these are repayable, this has to be paid back. Suppose you are investing, you are buying bond of a company, or you're investing a debenture of a company, right? After expiry of the term, this money will be paid back to you. This will be repaid. Okay, this is one major difference between equity and borrowing is that borrowing are repayable. Equities are not repayable. Equity, you are buying an equity means you are an owner. You may sell your shares to someone else. That's a different thing. Okay, but the company is not going to return you the money because you are the equity investor. But if you are a debt investor, then company has to repay. Okay, so that is the difference between equity and debt. Debt in India commonly we understand as bonds or debentures. Hope you understand. Then one more kind of source of long-term capital is also there. That is called as a term loan. Term loan means, as you can look at the slide, you can understand this is a kind of loan which is repayable within a defined term. You think of an example. Suppose you are buying a scooty on loan. You are getting that bike uh, through finance. Okay, and you must be knowing this loan is repayable within a particular period, maybe 5 years, maybe 3 years, maybe 8 years. So within a term of, let us say, 5 years, you have to pay the entire loan in the form of EMI, equated monthly installments. Okay, since it is payable or it is repayable within a fixed term, this kind of loans are called as term loan. Similarly, businesses, they also go for term loans. Suppose they want to install a plant on loan, or they want to buy a machinery, or they want to construct a building. They may take a loan for a fixed period of time. In the sense, this loan is repayable within a fixed period of time. That is called as a term loan. I think you have understood what is equity, what is debt, what is term loan. Then what is preference shares? Preference shares is another kind of share, not exactly like equity shares. Here, in preference share, the dividend amount is defined. What is dividend? You might be asking now. Dividend means, as you know, the equity shareholders are the owners of the company, or all shareholders are the owners of the company. When a company earns some profit, that profit is distributed among shareholders equally. Each shareholders get a fixed dividend. That means distribution of profit is referred to as dividend. Dividend distribution means company has decided to distribute some of its profits to its shareholders. That is called as the dividend. Right? So, but how much an equity shareholders will be getting, no one knows that. It depends upon the profit. It depends upon the number of shareholders. But if it is a preference share, then how much the preference shareholders will get as dividend? This is known. Okay, suppose it is a 10% preference share, then each preference shareholders will get 10% of the face value. If it is an 8% preference share, each shareholders will get 8% of the face value. Okay, so that is how. And these shareholders will be having a preferential right. That means they will be given preference as regards to payment of dividend. What does it mean? That means first, preference shareholders' dividends will be paid. After that, only equity shareholders' dividends will be paid. And the event of winding up of the company, when the company is getting closed, then preference shareholders are also having preferential right as regards to repayment of their capital. When we are closing the company, after all payments are settled, before equity shareholders are paid off, preference shareholders liability are to be settled. So therefore, they're called as preference shareholders because they always get preference over equity shareholders. Fine. The next type of capital under long-term capital is hybrid securities. When I say hybrid security, that means it's a mixture. It's a mixture of debt and equity. It's a combination. Sometimes they're also referred to as convertibles. That means it may behave like a debt sometimes, and sometimes it may behave like an equity. Suppose, let me give you an example. Suppose I'm issuing you a bond. For 3 years, it's a bond. After 3 years, it will be converted into equity. We call it as a convertible bond. It may be a convertible debenture also. In that case, what happens? For the first 3 years, it will behave like a bond. You will get a fixed dividend. And after that, it will become an equity. That means how much dividend you will get. It depends upon the profit. So this is a kind of security which we call it as hybrid securities. It's a mixture of debt and equity. One more type of long-term source of funding is there, that is called as internal funds. Internal funds means this is the money which is available within the company. Right? Maybe under different heads, different accounting heads, maybe under different fonts it is available. They're called as reserves and surpluses. Company creates these reserves and surpluses out of its profits. But if you see who is the owner of this profit, it is the equity shareholders. They are supposed to take that profit. If there's some reason they are not taking, this creates reserves. So the owner of the reserves are equity shareholders. Right? But the fund is available. It has also got a cost. When you will be learning cost of capital, you will be understanding that the cost of internal funds, that reserve funds, is very closely linked to the cost of equity. Because in fact, this is a type of equity. There are some differences as regards to computation of cost of equity and computation of cost of reserve. We'll be learning that in appropriate time. But right now you understand, internal fund means reserves and surplus. They are also a kind of capital. So these are the long-term sources of capital which are supposed to understand according to our syllabus content. I hope you have understood all this. Look at this chart now. This chart explains sources of long-term finance. Under internal category, you can see equity share capital, preference share capital, and retained earning. Retained earning means this reserves. And from external, you can find out debentures, that is bonds, term loans, and others. It might be some other type of loan also. So all of them are various types of sources of long-term finance. Okay. And when dealing with this long-term finance, these are the issues which relates to financing. First one is the cost. If you want to, let us say, take finance from a particular source, we need to know what is the cost. Then what is the risk associated with that? Third thing, what is the return? How it affects the return? What is the timing? Then what is the issue cost? What is the cost of issue? Suppose you want to issue equity shares, that it has got a cost. And this particular loan or money is available subject to certain terms and conditions. So what are these terms and conditions? That also I need to. Okay, these are the issues. Plus, what is the impact on WACC? WACC stands for weighted average cost of capital. That means if I take a debt, whether my weighted average cost will increase or decrease. And what is the impact on value? Value means the business's value. Okay, what is the impact on that? That means value of the business will go up or come down. Everyone, everyone is interested to increase its value. And cost of capital has an impact on it. So there is a need to know what is the impact on value of the firm. One more issue is there, that is control. What is control? Let us say there is a company, there are only two shareholders. Both of them are holding 50-50%. You can say they are controlling the company. Let us say they are inviting one more investor. An investor is coming, which is investing some amount at 20%. That means 20% will be taken by him. Another 80% will remain. 80% will be distributed among these existing two shareholders, 40-40. Now you see, earlier the person who was having 50% shares, now his share got reduced to 40%. This is how he's losing control. Let us say power of his vote was 50%. Now it is reduced to 40%. So as you bring more and more investors, so your control over the company gets diluted. So this is one more issue. So it's not that just like that I'm taking financing. This is when I'm taking financing decision, I need to know what is the cost of each source. What is the risk associated with each source? Suppose I have taken a debt, but I'm unable to prepay it. I do not have sufficient cash flow to pay EMIs or to pay dividend on bonds or to pay interest on bonds. I'm taking a risk. So when taking a financing decision, I need to understand the costs. I need to understand the risk and how my return is getting affected. I'm taking a loan means I have to pay interest. It will affect my profit. It will affect my tax. It will affect my return. I need to understand that. Again, I said time when it is repayable. Let us say you're taking a loan who is repayable after 6 months, and you feel that within 6 months you cannot generate sufficient cash flow to repay it. That means you are taking a huge risk. The timing is also important. When to borrow, when to repay. Again, I repeat, issue cost is also important. Suppose you want to issue equity shares. There is an issue cost, compliance cost. You have to comply certain legal formalities. If it is a listed company, there is a totally different mechanism to issue shares. You have to print prospectus, you have to print share application form, you have to appoint merchant bankers. So these are the issue costs that has to be taken into consideration. As you know, terms and conditions are important. Impact of this financing decisions over weighted average cost of capital is also important. Impact on value of the firm is also important. And what are the controls? Whether control is getting diluted and to what extent it's getting diluted, that also should be considered. These are the issues relating to business finance. So with this, if you look at your syllabus now, once again, the first part after this is over. Okay, we had already discussed today. I just wanted to recapitulate that. Now, next part is the cost of capital. We'll be understanding how to compute cost of equity, cost of debt, cost of difference, etc. We'll take a short break. After that, we are going to start. Thank you.